investing using Bollinger Bands. Understanding Bollinger Bands. Bollinger Bands consist of a middle band with two outer bands. The middle band is a simple moving average usually set at 20 periods. The outer bands are usually set to standard deviations above and below the middle band. How to use Bollinger Bands. To better understand Bollinger Bands, first, it is important to understand that the bandwidth is the difference between the upper band and the lower band. Because Bollinger Bands are based on the standard deviation, falling bandwidth reflects decreasing volatility, while rising bandwidth is indicative of increasing volatility. Relatively narrow bandwidth, also known as a squeeze, can foreshadow a significant advance or decline. The new advance starts with a squeeze and subsequent break above the upper band. A new decline starts with a squeeze and subsequent break below the lower band. Here you can see a squeeze and a subsequent break above the upper band. This break above the upper band is a bullish sign, and you will see that the price of the stock rises soon thereafter. Now, I will explain how to use Bollinger Bands on interactive charts. First, highlight the Apple symbol here, and type in the stock symbol. For this example I am using Netflix, then press enter. After the chart loads, I will turn on the Bollinger Band here. Next, I will expand the chart here to get a better view of the chart. After scrolling the chart backward, I can see a squeeze here. It is then followed by a subsequent breakout on the upper band, which indicates a buy signal. I will add some text now, so that I can easily find the squeeze and breakout of the upper band after I increase the time period. You will see why I am doing this in a moment. Now, when I increase the time period, you will see the location of the squeeze and the upper band breakout. Then you can see how the stock has increased in price. Now, this makes it easy to see how the price has increased after breakout of the upper Bollinger Band. You can zoom in or out, or scroll backwards and see the text, and then find the squeeze and breakout. Notice the price increase here. Conclusion: Bollinger Bands reflect direction with the 20-period SMA and volatility with the upper and lower bands. As such, they can be used to determine if prices are relatively high or low. Technically, Prices are relatively high wind above the upper band and relatively low wind below the lower band. Bollinger bandwidth is best for identifying the squeeze. After a squeeze, the price surge and subsequent band break signal the start of a new move. The new advance starts with a squeeze and subsequent break above the upper band. A new decline starts with a squeeze and subsequent break below the lower band. Find more investing videos and how to use interactive charts at investprofits.com.